I'm delighted to be joined by Michael Langton from Morningstar, Richard List from Waverton, Chris Gabbett from LGT Wealth Management, and Anya Berezav from Dunhill Financial for a Morningstar-sponsored panel session on investing strategies for US expats. Thank you all very much for joining us. How are you today?
Very well, thank you, Hugo.
Yeah, very good. Thanks, Hugo.
Excellent. Before we start, please bear in mind that for our audience that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. The panel will also be answering your questions at the end, so please add them in the Q&A pop-up at the foot of your screen as and when you think of them, and we'll try to answer them all at the end. So to begin with, I'd like to ask all of you to briefly introduce yourselves and your companies. Richard, would you like to go first?
Thanks, Hugo. Yeah, it's a pleasure to be here. So I'm a portfolio manager at Waverton, and I've been at the firm since 2007, and I worked in the wider private client industry since 1997. I head the US service here at Waverton, and I manage our model portfolio services, which are on the Morningstar platform, which Michael may be talking about in a minute. So you may be wondering, who are Waverton? I'll just tell you a little bit about the firm. So we're a London-based boutique investment management firm. We've got just over £9 billion or $11 billion under management. We've been in business 6, and we've had an SEC registration for just over 20 years. So I think that gives us quite a lot of heritage looking after US clients. We look after both resident US clients in the United States and US persons living overseas. We have 2 US client-specific solutions. So that is a model portfolio solution, which is available for clients with £100,000 or more. And there's also the option to come direct for a fully bespoke portfolio, which is available for clients with £1 million and above. Both the model portfolio and the bespoke portfolio are managed in a US compliant fashion. So we're very experienced in terms of the pitfalls and potential things that we need to avoid for US clients. And our investment approach, I think I tried to summarize it. There's a lot we could say, but I think I just summarize it as we're global, we're direct, we're consistent, and our investment process is very repeatable, i.e. it works in a variety of investment conditions and economic cycles. So I'll leave it there, and I'm sure we'll speak more during the course of the webinar.
Thank you, Richard. Michael, over to you.
Thank you, Hugo. Yes, hello there, everyone. My name's Michael Langton. I work for Morningstar Wealth Platform. I head up our US service for the group within Morningstar. So Morningstar Wealth Platform are a division of the Morningstar Group, US headquartered. I'm myself based in Jersey. We are a qualified intermediary to the IRS. So we do tax reporting on behalf of US taxpayers. We'll work with the investment managers to help them run model portfolios. And as an investor, you'll sit on the platform. We'll give you access to your portfolios through online and paper-based valuation systems. Morningstar itself are a global company operating across 29 countries. We operate both investment management and portfolio services. We have $270 billion under management from a investment management perspective, but certainly from a platform side of things, we run our own tech, and we've been part of the Morningstar Group for 7 months now. Previously, we were owned by an Australian company listed in Australia. So we've now got the backing of large US organization I'm sure many of you will be aware of. Thanks, Hugo.
Thank you, Michael. Anya?
Thanks, Hugo. It's definitely a pleasure to be here today, and thanks for having me as part of the panel. As you've mentioned, I'm a financial advisor at Dunhill Financial. I spent half of my life in the States, and I've been assisting US clients primarily with their investments and financial planning needs. Just a few years back, I moved back to Europe, and as an expat myself, I see exactly the difficulties that Americans are facing with their investments and financial plans while living abroad. And that's exactly what we focus on at Dunhill. As far as the firm, we were initially set up in Brussels. We're now headquartered in London. We're regulated in the US, UK, and Europe. And as I've mentioned, we primarily assist expats who are looking to move abroad or who have already moved abroad and are facing these different cross-border financial planning and investment issues. As a firm, of course, we pay a lot of attention to currency risks and how our clients are exposed to different currencies, and we have portfolios with low-cost ETFs that are specifically designed for different regions and several major currencies. As far as our services, we have our basic service for those those that are just starting out and are just looking for asset management. And then, of course, we have our financial planning arm where we do more complex plans for clients that are looking for more in-depth investment advice and long-term financial planning advice.
Thank you, Anya. Chris.
Thank you, Hugo. Pleasure to be here. My name is Chris Gavitt. I work for LGT Wealth Management US. I'm a partner at LGT, but my day-to-day role is one of investment management. I've been with the firm for 11 years now, and specifically working with US connected individuals for coming up to 8 years now. So LGT is the largest privately owned private bank in the world. We have been around for several decades now. We are family run, and we have an SEC registration. We applied for that registration back in 2012 and granted that. We're also regulated by the FCA in the UK. We look after anyone with a US connection, be it a green card, US passport, visa holder, individuals residing in the US, in the UK, wherever in the world, really. A little bit like Richard, we have two different services. We have a model portfolio service and a bespoke portfolio service. We can manage our models internally via our London or Jersey platform, or on Morningstar, or with our US custodian. Our bespoke portfolio service starts at £1 million and above, and with that we can tailor the portfolio to suit the client's need. Our overall investment philosophy, we are a global, despite being based in the UK, we are a globally focused company. We try and pick the best possible investments no matter where they are in the world.
Thank you very much. Well, for the next session, next part of this session, I'm going to ask some questions to our panelists. And let's start with Michael. Michael, you mentioned model portfolios and platforms. Would you mind explaining in a bit more detail about what these are?
Thanks, Hugo. Yeah, absolutely. Certainly platforms are probably quite an industry term and quite generic in terms of the kind of definition of that. But particularly in the financial services industry, platform refers really to technology which allows money to be ran and then accessed by an underlying investor. So certainly here at Morningstar, we're very much driven by the technology that we build, which allows money to be managed by what we would call a discretionary fund manager or portfolio manager. And that discretionary portfolio manager would manage something called a model portfolio. Now, a model portfolio is very simply an expansion of a fund. What we're doing with a model portfolio is we're unitizing a collection of assets so that an underlying investor can access that portfolio. And really the US service that we've been running for over a decade has given US taxpayers the ability to access the services of a discretionary portfolio manager, such as Dunhill or Waverton or LGT, and access it at a level which is accessible for more investors. Typically, the minimum amount you would need to go into a bespoke portfolio directly with a discretionary portfolio manager would be quite high. We use technology to allow that investor to access that discretionary portfolio manager, view the underlying holdings, and invest in a wide variety and diversified portfolio of underlying investments. And it also allows the discretionary portfolio manager to run that portfolio in a discretionary manner and have full control over that portfolio, again, using the technology of the platform and therefore linking the two together. So it's that technology from a platform perspective that's linking the underlying investor to the discretionary portfolio manager. We're kind of the conduit between the two, linking it in through the technology that we provide. And then obviously side benefits of that is the reporting, the 1099, 1042 reporting that we can do on behalf of the client, and then the access for them to view those portfolios as and when they require. Hopefully that answers the question.
That's great. Yeah. Richard, I think you mentioned model portfolios and bespoke portfolios. So what's the difference in the sense, does a bespoke portfolio also use the platform or a platform?
Yeah, thanks, Hugo. I think Michael's done a great job just explaining sort of the way the model portfolios work. So we as discretionary managers will partner with Morningstar, will use their technology and their platform, and that will allow a very wide audience of clients who maybe would be a little bit too small to come direct to Waverton. We talked about £1 million being our minimum, but those clients can then access a portfolio of our best ideas. So essentially the model portfolio allows clients to buy into the best ideas of the particular manager whose model they're following. With the bespoke portfolio, obviously we can do a little bit more tailoring. So obviously bespoke comes from the sort of clothing and tailoring industry world, I suppose. So as you'd expect, if clients say, look, perhaps I've got some assets already in the United States, so I'm quite well covered for US equities, I'd like you to focus on the rest of the world. Perhaps they have particular requirements around ethical restrictions. They may work in a financial sector, or they may work in a particular part of the industry that they already have a lot of exposure to via stock that they've accumulated through their employment. So all these sort of factors we can take into account when building bespoke portfolios. So I think two routes to hopefully get to the same point, but obviously with the bespoke portfolios, we do have the ability to tailor the portfolios a little bit more to take into account client-specific requirements. Obviously, for a model portfolio, you are getting our best ideas, so you'll get a very solid portfolio, but it is designed for a wide audience. It is available on a technology platform, and therefore we don't have the ability to bespoke for individual clients. So hopefully that gives you a flavour for the difference between bespoke, fully tailored, and model, best ideas, wide variety of clients.
Okay, thank you. So Anya, one for you. Let's say I have some money to invest, but I would like to access the funds in a few years, so not too long term. Would a model portfolio be a suitable solution?
Possibly, Hugo. So it really depends on your time frame. So if we're really talking for a shorter time frame, and if you have an exact goal you're planning for, you should definitely contact us for a customized portfolio for you, especially if your time frame is shorter than 3 years. We definitely wouldn't use the model. We would use something more customized. If you're thinking a few more years, so maybe 5 to 7 or 5 to 10 years, somewhere in that range, we would consider that more long-term. So we would primarily use our portfolios consisting of mostly low-cost ETFs that are appropriate for the country of residence for our clients. So we're very mindful of currency risks, and we always ask our clients, when you invest with us, where do you plan to use the proceeds from your investments, right? And then we design portfolios that take that into account, and then implement natural hedging strategies for different currencies. Of course, it's also important to mention that we only have up to 20% in satellite positions, so it's mostly a strategic allocation that we would use for the long term, if it truly is longer than 5 years. And I guess it's important to point out that we've had a growth tilt in our portfolios for quite some time. So that helped us to outperform over the last 10 years. Now, of course, the landscape is changing. We have better yields in fixed income. So I know we'll get to that part of the presentation when we talk about our outlook. So I'll leave it at that for now.
Okay, back to Richard. Another question on the model portfolios. How are they constructed in terms of geography and asset allocation? And how has this worked out?
Yeah, thanks, Hugo. So I think it very much depends on which particular mandate the client is following. So we have 3 different mandate options, and they're available in both US dollar denominated portfolios and sterling denominated portfolios. But essentially, the growth mandate would have about 75% in equities, 25% in other assets, fixed income and alternatives. The balance mandate would have about 60% in equities, and obviously 40% in those other assets I've mentioned. And then we have a cautious mandate, which would be about 45% in equities, and the balance obviously would make up a much greater proportion of those assets. So depending on risk appetites and depending on a little bit, as Andy was saying, sort of time horizons, tolerance to risk, sort of what money's for and what the client would like to achieve for it. We have 3 different options there. In terms of the actual allocation regionally, we are very global. So, we would look for our best ideas around the world. What that tends to mean is that roughly 50% of the equity allocation, so that's 75%, for example, in the growth mandate I was talking about half of that would go into the US equity market, and the other 50% would be split across the across Europe, across Japan, across Asia, and across the UK. So we'd have a nice globally diversified portfolio of our best ideas, but it would be, broadly speaking, about 50% in the US and 50% in those other markets. Obviously, we can tailor that. There'll be times when we're a little bit overweight equities, we're underweight equities. We can change the regional allocations if we feel it's appropriate to do so. So obviously, we have full discretion to do those things. But broadly speaking, that's what we'd expect to have for those mandate types.
Okay, thank you. Chris, one for you. What's your stance on UK tax wrappers such as SIPs and ISAs for US taxpayers?
Yeah, thanks, Hugo. So effectively, and I'm sure Anya and Richard would agree with me, a lot of what we do in terms of our typical planning techniques for a UK individual does not really suit an individual with dual citizenship, or effectively one foot in the UK or outside the US and one foot in the US. It really does come down to tax. Now, the 2 tax codes between the UK and the US don't particularly marry up that well. And therefore, certain things that work very well in the UK do not work particularly well from a tax perspective in the US, and vice versa. So what you're left with is a small number of wrappers that work well in both jurisdictions. So I'll sort of break them down into sort of ISAs, SIPs, and then we'll go on to sort of the US equivalent, if you like. So ISAs, clearly very good from a UK perspective. There, any assets inside that ISA, inside the wrapper, are allowed to grow free of tax, and the income produced within them are also free of tax. Very, very good. But from a US perspective, the IRS actually deem that a look-through vehicle. So actually, they aren't so tax efficient from the US eyes. That being said, there is a small benefit between the 2 tax rates. Take, for example, the capital gains rates between the UK and the US, for example. The US is slightly better. It's a slightly lower rate for capital gains, and therefore there is a very small benefit of investing into an ISA, particularly when you've sort of built up a lot of holdings in your ISA, and then you move to the States, for example. With a SIP, a UK pension works very, very well in both jurisdictions. One of the very few things that does work so well. We have many clients with SIP accounts, and effectively it's very similar to an ISA, where the assets inside the SIP are allowed to grow free of tax. Any income produced during the investment time horizon are allowed to sort of be tax free. You do have to be careful because you're going to be paying tax on any withdrawals from that SIP. If you are a US resident, for example, any income from that SIP is going to be taxed in the US, and vice versa. If you're a UK resident, then the income is going to be taxed in the UK. But all in all, actually very, very tax efficient from both HMRC's perspective and the IRS's perspective. The equivalent in the US are what's known as IRAs and Roth IRAs. So an IRA is effectively a personal pension. It might have been sort of rolled over from a workplace 401k. And effectively, again, it works very, very well from a UK perspective and a US perspective. Assets are allowed to grow free of tax within those IRAs and Roth IRAs. And any sort of income from the IRAs, obviously, you've got to pay tax on it on the way out, whether you're a UK resident or a US resident. But really, they should be sort of front and center of any sort of planning. For people still working, we always suggest contributing to those wrappers because, as I say, they are one of the few areas that do work for an individual with 1 foot in the US and 1 foot outside of the US.
That's great. And for the audience members who aren't in the UK, those are UK specific vehicles, aren't they?
So the ISA, you've got to be a UK resident to contribute to an ISA. You have a contribution allowance of £20,000 per UK tax year. With a SIP, with a UK SIP, it's a UK product, but we often see individuals that have moved from the US to the UK, worked in the UK for 10, 15, 20 years, and have been contributing to a workplace pension, and then sort of done nothing with it, and then returned to the US and thought, right, okay, I've got this quite nice pension pot here. What do I do with it? Well, at that point you have several options, but typically a lot of people would choose to move it into a SIP where you have more flexibility in terms of the investments you can hold, and flexibility in certain sort of withdrawal areas. But yeah, that is very much a UK specific product. Again, in terms of where that can be managed sort of on the Morningstar platform or directly with a wealth manager. And then I mentioned IRAs and Roth IRAs. They are very much the US side of the pond. Again, it doesn't, if you move away from the US, it doesn't mean you have to, give up that tax wrapper at all. You can continue to hold it, and it continues to be tax efficient.
And can you continue contributing to
yeah, so yeah, good question. Unfortunately not. Okay, so if you for example, with an ISA or a SIP, SIP is a bit different because there are some nuances, but for the most part, as soon as you move away from the UK, you cannot contribute to a UK tax wrapper, be it an ISA or a SIP, and the same goes for the US. So if you did have an IRA or a Roth IRA and moved away from the US, then you would no longer be able to contribute to that product.
That's great, thank you. Another question for you, Michael. Does an expat's country of residence make any difference to whether they can use the model back to the model portfolios? I think our audience are largely in Europe, but we've got, I think, some people as far afield as Australia and New Zealand. So can they all access these model portfolios?
Thanks, Hugo. Yes. The one thing I will caveat with how the Morningstar Wealth platform operates is we are what we call intermediated as a platform solution, which means that we always will be kind of interacting through a regulated advisor, which means that any access that any investor would have to the Morningstar Wealth platform would be via a regulated advisor. So we don't have something called execution only or direct access for D2C, direct access for clients, which means that we've got to have that intermediation. However, there is no restriction in where you are residing, apart from kind of some small CDD compliance issues with certain jurisdictions at the moment, not naming any in particular. But outside of that, there is no restriction in where you're residing. It's kind of a follow-on from the question that Chris had, I suppose, in terms of the tax wrappers and the products that you would be working with. Now, from a Morningstar Wealth platform perspective, we have a wide range of tax wrappers available, ranging from SIPs through to ISAs, and also different QROPs, offshore bond structures, some or most of which may or not be suitable for you as an individual, depending on your personal situation or where you're residing. But with the Morningstar Wealth platform, there is lots of variety in terms of the tax wrappers available, whether it is a UK resident or it's someone that's lived in the UK but that is now living in Spain, for example. There are lots of different solutions there, which is why we intermediate through that advisor, because they will have the local knowledge on where you're based in terms of what your requirements will be.
Brilliant, thank you. Anya, do you, at Dunhill, do you have minimum requirements on the amounts that expats can invest?
Great question, Hugo. We don't have a minimum, but of course, each client, advisor, and partner should make sure that any fees they have are appropriate for the size. So therefore, it probably won't be beneficial to start with less than, say, 20,000 on Morningstar. But if you have less than 20K to start, you can check out our sister site, DF Direct, where we do not have any minimums there.
What's DF Direct?
That's our sister site that allows U.S. expats or any U.S. associated persons to actually start investing without necessarily having a minimum. That's an obstacle that a lot of U.S. Younger investors, I would say, are facing, that are looking to start investing, but there isn't a platform available. So if you just have, say, 500 or 1,000 or 2,000 to start, there are solutions for that, and that's DF Direct. That's our sister site.
Okay. Thank you very much. And Chris, back to you. What client scenarios do you often come across? Who are your typical clients, I guess?
Yeah, thank you. Well, typical clients, we look after a lot of private clients. We look after charities, pensions that I've already mentioned, companies. All of the above are anyone effectively associated with those, with those accounts with a US connection. We can certainly look after. In terms of sort of, typical scenarios that we come across, and it's probably very similar to both Anya and Richard, we see a lot of migration between the US and going into Europe or the rest of the world. There are vast amounts of people leaving the US for jobs. You only have to look to Ireland, where you've got a huge tech industry, pharma industry, where there's a lot of migration going there. And effectively, as soon as they, are resident in Ireland, they potentially have a sort of, an issue with ongoing planning, ongoing financial advice, and therefore they need a wealth manager or a planner to sort of assist them with that advice. So that's very common. We often, as I say, we often see people moving for work. We often see people moving, to the States for retirement. Classic sort of individual moving to Florida from the UK. I can't think why, but it may be something to do with the weather. But that's a very common circumstance. And again, it's depending on what they're invested into, what their wrapper is. Well, a SIP, for example, must remain in the UK, or should remain in the UK, if you want to keep that tax status. So effectively, you need to find a UK manager at that point, despite residing in the US. So other sort of scenarios that we see, it's rather crude, but we see the accidental American all the time. And it's something, that really started LGT, back in sort of 2008, I suppose, when we started looking after US connected individuals. We came across a lot of individuals that were born in the States, spent very little time over in the States, and had been in the UK, ever since 30, 40, 50, 60 years. And at some point in the future, they've been told, have you been filing a US tax return? And by the way, are you invested into things called funds and PFICs? And at that point, I hand over to their tax advisor to give them the bad news, unfortunately. But effectively, as I said, we call them accidental Americans because there really wasn't the knowledge that said you've got to file a US tax return, and by the way, you're potentially subject to tax on your worldwide assets. And I suppose it's for us, as sort of industry experts, I guess, to sort of navigate all of that along with their tax advisor, to make sure that they're sort of, one, kept up to speed with their US tax filing, but also from a planning perspective, they are considering US tax issues. They are considering UK tax issues if they're a UK US individual, that is. And the investment piece also makes sense for that individual.
So it's a good question. You're talking a lot about the UK. Do you all accept clients from different countries, or Chris, are your clients in terms of Americans, UK based only, or no. I think that's a question for all. Yeah,
we're able to work with pretty much any client resident wherever in the world. There are some countries that we unfortunately cannot work with, but they are very few and far between.
as in the sanctioned countries.
That's correct, yes.
Yeah. Is that, Anya, is that the same for Dunhill?
Yeah, absolutely. That is very similar. We can work with clients, U.S. associated clients anywhere really around the world. Most of our clients, though, come from the UK, France, or several other European countries. But of course, the sanctioned countries, those are the very few we cannot work with.
Is that the same for you, Richard, in terms of
it is indeed, exactly as Chris and Anya just said. You know, we're very happy to welcome US clients wherever they're based, obviously with the small number of exceptions that have been mentioned.
Yeah. Okay. So finally,
sorry, Hugh, I was just gonna mention there quickly. Yeah, so it's the same for Morningstar from a platform perspective, and one of the reasons we have our base for the offshore platform in Jersey is because it's very much suited to that global environment, and the regulator is very strong and understands that global market. So we are very fortunate to be in a position where our regulator understands that global market. So it's not, it doesn't necessarily matter whether you are based in France or the Middle East or Southeast Asia somewhere. We've got kind of a very good understanding of that global world and how that works for the resident that's there from an investor perspective. Sorry for interrupting that.
No, that's great. Good to know. And so finally, before we take questions from the audience, I think everyone would appreciate hearing all of your thoughts on how you feel the coming 12 months are going to look and how this will affect the investing landscape. I think everyone's aware. We'll read in the news about inflation and several other possible recessions and things like that. So I think, should we go around one by one and get your take on how 2023 is looking and how that affects the investment landscape for American expats? Michael, would you like to have a go at that one?
Yeah, I think I'd quite like to jump in first and say before everyone else that the future is uncertain. There's no prediction of what might happen, which I'm sure will be echoed by everyone else on the call. But it is a very pertinent point. It's very difficult to predict the future, and no one will ever kind of sit there and predict what will happen and probably ever get it right. But certainly from an investing perspective, it's certainly a volatile market. 2022 particularly was one of the most volatile markets we've seen in recent years, decades. There's always the rhetoric of it's time in the market rather than timing the market, which again, I'm sure is a phrase that will be kind of echoed by my panelists, but it's very much a case of being invested. And again, one of the reasons we work with what we call intermediaries, the regulated financial planners, such as Dunhill, is they're there to hold your hand throughout those journeys and throughout those kind of times of volatility and when markets are going down and it's uncertain about what's going to happen in the future. The one thing every financial planner will always say is you have to stick in the market and kind of ride those bumps to kind of come out the other side. In terms of where our analysts are talking about things happening in the future, again, it's very uncertain. There's things happening in China, which is fairly positive. There's kind of movement in energy, which, you know, potentially might mean particular asset classes are less favorable. There's been profits taken from particular asset classes. I think who knows whether there will be a recession and how much that will affect the markets, but I certainly think there's still more volatile or still more volatility to come. There's still things happening in the kind of macro environment which is affecting markets around the world. But I will just reiterate that it's all about being in the market and kind of working with your financial planner to to make sure that you kind of make those right decisions at the right time. That's all I'd say. Thanks for letting me go first as well.
Who'd like to go next? Anyone? Richard, would you like to have a go?
Thanks, Hugo. Yeah, I think I'd start by echoing what Michael said. I think that's absolutely right. It's all about time in the market rather than trying to time the market. So essentially, once you've made the decision in terms of the mandate and what you're trying to achieve, the asset allocation decisions and the stock selection commission decisions will ultimately what drive your return. Obviously, it's great to get in and buy when stocks have taken a tumble. That gives you a nice start. But ultimately, as I say, it's more about time in the market. I think maybe just to sort of expand, the story last year in 2022 was about inflation. So everyone knew inflation was coming, but I think the scale and the speed with which inflation hit, which was exacerbated by geopolitics, the energy issues falling out of the war in Ukraine, etc. I think people were probably a little bit wrong-footed by that. So global investors had to readjust. We saw bond yields rise very substantially. And we saw equity markets, generally speaking, derate quite substantially. So as we know, a lot of technology companies had led the market over the preceding 5, even maybe 10 years. They were very expensive. And as we enter this new environment where suddenly bond yields are back, you could invest in bonds and get a sensible return. Perhaps those future earnings from some of these technology companies were not worth quite as much today as they were, when bond yields are very low. So essentially the environment changed very rapidly. Where we are now is slightly different. I think, people are talking about inflation either having peaked or sort of peaking very soon, depending on where you are in terms of US, Europe, UK, etc. But it feels like, we're probably through the worst of an inflationary shock. So inflation is at or near a peak. Interest rates, as we know, have risen substantially around the world. And now, the thinking is, are we at the peak in inflation, in interest rates as well as inflation? Are we going to see the Fed, the ECB, the Bank of England raise more, or are we getting close to that peak? Now, at the moment, most of the central banks are still suggesting that they have a bit more to do, and that's probably correct. But generally speaking, analysts are sort of bringing their target for where they think interest rates will peak down a little bit. So, for example, here in the UK, the consensus is around 4.25% as the peak, and a few months ago that probably would have been about 4.5%. So that doesn't sound a lot, but actually it is quite significant in terms of just bringing that peak down a little bit. There's a lot of uncertainty. Michael's quite rightly said, nobody quite knows the extent of China reopening, the geopolitics that I talked a little bit about. An awful lot is still in play. So it would be brave to sort of be too prescriptive about what would happen. But, I think there is a risk of a US recession. We've got that risk at about 60% at Waverton. So we don't think it's a given, but we think there is a chance of recession. Having said that, the fact that we're talking about a recession may not be as bad as you would think for markets. Often markets will reprice in anticipation of the recession, and then when you get the recession, the market is then looking forward to the recovery that's coming. So actually, sometimes stocks perform surprisingly well, or certainly much better than expected when the economy is actually in recession. It's that pre-recession period that actually is probably the most difficult period for markets. So I think the fact that we're talking about recession, obviously that's not great news. It's tough for people who are going to lose their jobs, and so I wouldn't want to downplay that. But in terms of investing, we have to be cognizant that we're probably looking at the next 6, 12, 18 months, maybe even 2 years, by which time the economies are probably going to be looking in better shape. So a lot in the mix there. As I say, a chance definitely of a US recession, although at the moment, a number of factors still look quite robust, particularly around employment numbers. So employment on both sides in Europe is looking pretty solid at the moment, so we'll see if that persists. And I think generally speaking, as I say, if inflation is on this downward trend, interest rates around the world are getting towards their peak, and people are then perhaps starting to think about rates being cut in the future. That is not a particularly bad environment. That could be quite a supportive environment for risk assets. So I'm a little bit more glass half full, I think, this year. I think a lot of the pain was taken in 2022, and I think 2023, I don't think it's going to be a vintage year, unfortunately, but I do think it'll be a year of healing and a year of assets sort of starting to look forward, starting to discount, better times to come. So that's probably more than enough from me. So I'll finish there.
Oh, that was thorough and yeah, very interesting. Thank you. Anya?
I guess I'd want to start with a quote from an American-Canadian economist relating to something Michael was saying, that the only function of economic forecasting is to make astrology look respectable. I find it quite funny, so does my team. So just take that definitely with a grain of salt, as we do not know exactly what's coming. But when we look at kind of where we've been and where we're going, I think currencies are going to play a big role in 2023 to even a greater extent than they did in 2022. So really, when we look at the last 12 months, we're dominated by a very strong dollar story with a flight to safety and quality. And that was, of course, partially driven by widening interest rate differentials between the US and other developed countries. When we look at the next 12 months, it's likely to lead to outperformance in ex-US regions or assets with a weaker dollar, possibly. So as a firm, we're looking to emerging markets quite broadly. We have interest, of course, in China and Southeast Asia region, as well as Europe, where valuations are historically quite cheap. So even if you're a little cautious on emerging markets and China in general, a lot of large cap US companies actually have substantial revenues derived internationally. So about 40% of companies in the S&P 500 have their revenues from abroad, and 58% of the tech sector have revenues from outside the US. So that exposure is definitely there. How will this generally affect the investing landscape? Of course, with those interest rates finally in the positive territory and actually quite attractive, that changes the landscape for those conservative income-oriented investors, our retirees on fixed income. This group of investors, of course, is able to get their desired return with reduced equity risk, and that's more predictable for their cash flows. So that's very positive, I think. And how long will that last? That's definitely anybody's guess. But those yields are looking definitely attractive. We've historically had a growth-oriented approach, and in the last decade or so, that worked quite well. But with those better bond yields and that changing, that produces a lot of opportunities ahead of us. So that's where I will end, and I'll turn it over to Chris, who hasn't had a chance to talk yet on that topic.
Thank you, Anya. Thank you. Yeah, look, I'm not going to repeat what the other panelists said, because I agree with all of it, really. The one thing I would say is, look, the most common phrase I've used so far this year is cautiously optimistic. Just going back on what Richard mentioned is, the shoots are there. Inflation is coming down. Central bank policy seems to have worked so far. And with the likes of sort of China reopening, from their sort of zero COVID policy, Germany's actually sort of brought down their requirement for gas. They haven't used as much gas over the winter period. It actually looks, as I said, cautiously optimistic, relatively positive. We agree that there's probably going to be a recession. That most likely it's going to be a sort of soft recession in the US. But as Richard said, actually, equity markets tend to dip before a recession actually occurs. So actually, we believe that we've seen a lot of the bad news, and that can go with, both sort of macro data and also sort of valuations of equities too. Just following up from what Anya said, look, going back a few years ago, there was a common phrase called TINA, there is no alternative. Now investors do have an alternative, and actually, bond markets do look quite attractive. The yield on those bonds look very attractive. And if you're a cautious investor sitting on cash, it's a good opportunity to start to invest that.
Thank you all very much. It's very interesting, and hopefully our audience felt the same. So we've got a lot of questions here, and I'm conscious of time. So what I might do is ask, put one of these questions to each of you, see how many we can get through in the time we have. So, Michael, seeing as you weren't first last time, let's keep going. And I'm not sure, possibly you may defer this to someone else actually, but the question is, can you speak to whether it makes sense for Americans residing abroad to maintain qualified retirement plans in the US, having moved abroad? Actually, did we cover that earlier? I think we didn't.
Yeah. So sorry to butt in, Michael. Okay. Apologies. Yeah. Look, overall, it does make sense for those plans to be kept in place. It does depend on what country you're residing in, but for the most part, there is a treaty between the US and another country, and for most part, IRAs and Roth IRAs are covered under that treaty as being tax efficient wrappers.
Okay. Anya, let's go back to you. I think this is back to the model portfolios. Are there options for carbon-free and socially responsible portfolios?
Absolutely. As a firm at Dunhill, we definitely pay a lot of attention to making sure that our portfolios are on the path to being socially responsible. As a firm, we want to be a fully socially responsible firm within a few years. So there's definitely options for U.S. expats to look at those type of portfolios whenever possible at Dunhill. Whenever a substitute exists for say an S&P 500, we use the more socially responsible version, KLD 400, which is just the S&P minus the 100 dirtiest companies. So whenever possible, and the replacement is a suitable, feasible solution, we use those kinds of solutions for the portfolios. Of course, the difficulty within this entire landscape of socially responsible is that it means something different to people, right? And so we're constantly surveying our clients to see what it means for each individual. And as much as possible, we try to tailor to those needs, as that is definitely an important part of the investing world right now. How do other panelists feel about that?
Very similar to you, Anya. Very similar. We have and on Michael, you know, on Morningstar, we have access to ethical portfolios, sustainable portfolios on there. So yeah, overall, very, very similar to yourself, Anya.
Yeah, I think I would echo that as well. We're actually signatures of the principles of responsible investing. We do a huge amount of screening of all the stocks that we buy. We look at the companies in great detail, and if there are issues or red flags, you know, we'll just walk away. So it's become a big part of our investment process, and it's very central to the way that we pick stocks and bonds.
Yeah, and then just lastly, from a Morningstar perspective, we're heavily involved in the ratings and the kind of environment around how a stock, a fund, any asset is deemed sustainable through some of our kind of group companies such as Sustainalytics and our ratings through Direct. So as a group, we're very, very conscious and do a lot of work in that space as well.
Thank you, Michael. There are lots of tax-related questions, and I'd say some of these may be more appropriate for tax professionals. And we have 4 sessions tomorrow with US expat tax professionals. So, and actually, in particularly Daniel in Canada, I know you've been asking this question throughout the day, but it is a question for a tax professional, and that's a question you should save for tomorrow. Another question I think for all of you is, it slightly relates to tax, but I think it's one that's relevant, is are your portfolios both PFIC free and MiFID II compliant for US connected individuals in the EU?
Yeah, I'll jump in there quickly, yeah, because we obviously do the tax reporting on behalf of you as the underlying investor. So as a qualified intermediary, each year we produce the 1099s as well as the 1042s, and we issue you a copy. So you'll get a copy directly via your investor portal, which is provided by the platform, and we're also kind of sending one directly to the IRS. From a PFIC perspective, I'll hand over to the guys on that side. But one of the benefits of our US service is that we're only working with managers such as Dunhill Financial, LGT, Waverton, that are running those SEC recognised portfolios that are very conscious of that PFIC issue. And really the way that we position it to the advisors that we work with will be, we're doing the tax reporting. We've got all of that data to send to the IRS and to send to you in terms of those 1099 tax reports and tax reports and tax backs. And then we're working with a range of managers that are running those suitable portfolios. But I'll hand over to the guys to touch on the PFIC side.
Thanks, Michael. Should I just pick up? Yeah, I mean, absolutely. So PFIC, you know, I'm sure most people are aware that's passive foreign investment company. So essentially it means any non-US collective investment. So it's OICs in Europe, it's unit trusts in the UK, it's investment trusts, anything that is a kind of wrapped investment. And the issue there is that these structures are taxed in a very punitive way in the US. So I won't go into lots of detail, but essentially they're best avoided. All our portfolios are designed to be completely PFIC free for US clients, so we don't go anywhere near them. And we will look at either investing directly, as I've mentioned, or occasionally we will use US listed ETFs. When we're buying US product, we'll also make sure that it is HMRC reporting status. So it is also suitable for the UK residents. Now that may or may not be relevant for the individual investor. They may not have any UK reporting, but I think it just gives comfort that we can work in both jurisdictions. So essentially, the short answer is yes to the question. We have none of those issues.
And the same at Dunhill, the short answer is also yes. I would just say, for any of the audience members that have had a PFIC issue, they realize how painful it might be. And so we definitely, all of us pay close attention to make sure not to cause those tax issues and to be very careful with investment selection. To add on to this, as far as MiFID regulation, right? That's the European regulation that, unlike in the US, it's not necessarily being enforced, but just because it's not being enforced, it doesn't mean that we aren't preparing for it to eventually come to play. And so we definitely want our portfolios to be both compliant as far as the US side, as well as the European side and UK. So depending on wherever you are in the world, we definitely pay a close attention to be sure we're keeping you out of tax trouble as far as investments.
Chris, do you want to say something on that?
Yes to tax reports, no to PFICs, best avoided, and yes to the MiFID or following of MiFID regulations.
Yeah, just to follow on that from a platform perspective, we are a MiFID II compliant platform, so we're doing all of the ex-ante, ex-post reporting. We're sending out all of the 10% drop letters and all of the other kind of responsibilities that fall within a platform's responsibilities through the MiFID II requirements. So yes, as a platform, we are as well.
Thank you. It's a question from Constance about your fee structures. Is that something you might all say something briefly about? Who'd like to? Michael, that's probably not because you don't work with expats directly. Should we go straight to somebody else?
So given that all of our model portfolios are on the Morningstar platform, there's a fairly transparent fee schedule that I believe we all follow, and that's sort of 85 basis points, which would include the investment management fee and the custody fee for Morningstar. At LGT, if a client or an advisor wanted to come directly to us, the fees are slightly more. And you're looking sort of 1% as opposed to 0.85 for the advice.
Richard?
Yeah, very similar. So we're all on the same wavelength in terms of the fees, the model portfolios. So we charge 50 basis points, and it's another 35 basis points for the platform. So 85, as Chris has mentioned. And then actually, as it would happen, we also charge, it's tiered, but it starts at 1% on the first 2 million, and then it tiers down for the bespoke portfolios. So again, you're paying a little bit more. You have obviously the more flexibility, more customization, and then for the larger amounts, we can tier that amount down in terms of what we charge.
And Anya, is it the same, I suppose?
Yeah, definitely very much the same as far as portfolio pricing on Morningstar, the 0.5 plus 0.35 from Morningstar. And very similar to what Richard said, it's a tiered system depending on the asset level that clients are coming to us with. For us specifically, the fee is 1% between 500 to $1 million. It drops to 0.8 above $1 million, and it's a tiered schedule. What's really different with us is for clients that have assets that we are managing over 5 million, we drop to a flat $25,000 fee per year, and it doesn't go above that even if they have 10 or 12 million. So that's, I would say, possibly different.
Thank you. There's a more sort of general rather than technical question here. Again, something I'd be interested to have your perspectives on. What attitude should an expat investor have? Chris, yes, let's start with you.
Well, look, it's not all bad news. And as I said, look, you know, when you realise you potentially have an issue, whether it's PFIX or tax reporting or whatever, it's all quite scary. But actually, you know, it's really not that complex. So the attitude US investors should have is one of a positive nature, really. You know, there is a solution. You know, we're all capable of providing a solution for you, whether it's planning or the investment side of things. So it's not all bad news. That's what I would say.
Yeah, I'll just add on to that to mention that when you're a lot of the time growing up in your home jurisdiction, when you were born, when you're not an expat, there's often structures in place to help you with your retirement. In the UK, there's kind of the SIP and pension arrangements. It's the same in the US. When you become an expat, you sometimes lose some of the benefits of having those structures in place around you. So I think in terms of the attitude of an expat, you have to make more of a concerted effort to fund towards your retirement and your end goals, whatever they may be. So I think that's sometimes quite difficult to kind of self-discipline yourself to be in that position where you're kind of putting structures in place. And again, you know, people like Anya will be well aware of that. It's very important to be talking to a financial planner about those things.
Great. Here's an interesting question. Anya, you mentioned currencies. Are there any indicators or predictors to gauging when to move currencies between countries? I suppose
anyone wants to tackle the crystal ball question.
Well, you all did very well with the crystal ball earlier about the rest of this year, so I think it's a fair game. If you have other indications in some sense of the way currencies are moving, or not necessarily.
I would say generally, you know, as far as the US dollar, we've seen a lot of strength in US dollars as people in the US dollar, especially last year, as people are moving to safety. That's the US currency. That's where we've seen the dollar be so strong, and possibly still overvalued, right? Again, that's a crystal ball question, but when we look at historical trends, dollar tends to go in 10 to 15 year cycles. We're kind of towards the end of the strength cycle, so we could definitely see some weakness moving forward. But that's, again, not fully predictable. What do you guys think?
Yeah, I think that's right. And you know, as you rightly said earlier, there was a interest rate differential last year, and I think general investor nervousness. So people tend to flock to the dollar in those kind of times. You know, where do we go from here? Probably the dollar will weaken a little bit. We're not massively bearish on the dollar though, but you know, it has been extremely strong. It's been a kind of king dollar situation, and so we probably will see some gentle weakening from the dollar. Euro, by contrast, was very weak. And with the slightly better European economic environment that I think Chris mentioned, you know, we probably logically would expect euro to strengthen a little bit. Sterling, gosh, it's very difficult to predict, isn't it? It's there's so many moving parts. It's quite a political currency, so it's probably going to get kind of caught between those two big moving plates, I guess, between Europe and between the US. We'll be kind of squeezed somewhere between the two in terms of sterling. But I think, you know, generally not massively bearish on dollar, but it has been so strong, it's probably going to get a little bit weaker. And again, conversely, euro has been extremely weak, probably going to continue to get a little bit stronger.
Chris, any thoughts? Or
no, I completely echo those thoughts. You know, interest rates in the US was, you know, raised a lot quicker last year. You know, from an economic sense, that would sort of mean that the dollar was stronger, along with the fact that there was sort of, you know, turmoil in markets and people sort of wanted the dollar. Again, look, we as a house, we don't think that the dollar is going to fall significantly, but it's probably due to weaken over the course of the next sort of 12 months.
It's an interesting idea that the dollar is a safe haven. So in times of, I guess, I suppose, you know, the Russian invasion of Ukraine and events like that, and political events in the UK, and then people turn to the dollar, and that's, I think, you know, addresses the question pretty well. It's possibly an indicator if we see turbulence, unexpected turbulence, perhaps. Is that a right assumption that if we see unexpected turbulence again, that would strengthen the dollar particularly, or not necessarily?
I think, that probably would put a bit of a floor under the dollar. I mean, the other classic ones, obviously Swiss franc, and you've got, strange enough, the yen actually always does quite well in terms of turbulence. I guess maybe if there was a localized problem in Asia, that may not be quite so true. But I guess a lot of these events are taking place by and large geographically a long way from Japan, so perhaps that's one of the reasons why you see that. But I think in very general terms, yes, is the short answer, and probably you'd see maybe a bit more strength in terms of Swiss franc and yen if there was a big geopolitical shock.